Yeah, so what I wanted to talk about tonight was orders, like, putting in orders for trades, right? So say, for instance, if you're going through the chart or you got an idea that you want to buy something, let's just go through the mechanics of orders, putting orders in, talking about the order types so you can, get familiar there. Depending upon which brokerage you're with, some people trade on their phone, some trade on the tablet, some trade on a computer, but overall, most order types and putting in orders, they have a lot of similarities. So what I'm going to go through, you may have a little bit of deviation on them. However, some of the basic stuff should be there. All right, so you all can see my screen. I have, so I'm on a TD Ameritrade, and I have the stock profile up. And let's say I wanted to buy the stock. So you have a buy, typically you're gonna have a buy button and a sell button. But the buy and the sell just kind of depends. So let me talk a little bit about the bid and the ask. All prices and stocks, they're always gonna have a bid and the ask. So a bid is just say, for instance, somebody wants to buy it, then they're gonna put up a bid. Then the owner that wants to sell it, they'll say, I'm asking a certain price for it, and I don't want to take any lower than that. So you have these two prices that are always changing, and depending upon how much activity is for that particular stock, then the bid prices can be small. So you can see here on the screen, NEO has a bid at 43.22 and has an ask at 43.25. So that's a very tight spread, only a 3-cent spread. The tighter the spreads is indication of how many market participants or liquidity is there. And so liquidity is just mean there's a bunch of people that's interested. They're constantly buying and selling. And the tighter the spreads mean you're going to get the best price for it. When spreads are wide, then that means you're gonna have to if you're selling it, you're gonna possibly sell it for less than what you want to. And if you're buying it, you're probably gonna have to pay more than what you want to as the spreads expand. So you want to find stuff with tighter spreads are better, so you can get in and out quickly, so you don't get trapped into a stock. And further spreads, are kind of detrimental for you when you're trying to sell. So if I wanted to do an order, I can say buy. So I'm gonna click on this for a buy order, and then you can see down at the bottom. So I have an action to buy. And then you can see order type. So there, I'm gonna expand this. So in here, there are several different order types. There's a limit order, there's a market order, a stop market, stop limit, then there's trailing stops. So we're just gonna go kind of with the basics first. Let's say, for instance, if the market was open right now and you wanted to buy this stock and you wanted to buy it immediately, you can put in a market order. And what happens is, as your order is routed to the brokerage, and then the brokerage would actually, they're responsible for putting your orders out there and then getting it filled. What will happen is whatever the price is by the time it reaches the market, that's what it will get traded for. So if in fast moving markets, and particularly in things that are like IPOs or breaking news or some scandal or accounting news, if you put in a market order, depending upon how wide the stock is varying one side to another, a market order, if you're buying, it may cause you to pay more than what you want. And if you're selling, it may cause you to sell for less than what you want. But a market order is just going to trade as soon as it get there, whatever the current price is, then that's what it's going to buy it for. Right? All right. A limit order is the opposite. A limit order. So when I clicked on limit order here, what happened is you'll see a price box show up on the right. And so what a limit order allows you to do is say, hey, I want to buy or sell only if the price is at this price or better. So if I'm buying, then I say, I don't want to pay any more than $44.56, right? So I can put in $44.56 here. And if the price is above $44.56, then the order will not get filled. If it drops below $44.56, then it's going to turn to a market order and it should fill immediately. So that's a limit order. All right. Then you have stop orders, and a stop is typically, I use stop primarily as once I buy a stock and I'm in it and I'm trying to protect profits. So say for instance, like Kyle said, he was in NEO at 20 or 28, right? He could have put in a stop today and said that, hey, I'm gonna put in a stop at $43. And as long as NEO stayed above $43, then his stock would not have gotten sold. But if it breaches the $43 level, then that stop order is going to instantly change to a market order, and then it's going to get filled as soon as possible, right? And sometimes you have buy stops too. If you want to buy something at a particular area, but you want to buy it higher than what it is, but you only want to buy it once it eclipses a certain price. So for instance, say again, we're looking at NEO is trading at 44.56. Let's say I wanted to buy this stock because I looked at the chart and I said, if it breaks out above 50, I want to buy it. So you can put a market stop. You can put a limit stop order in and say, hey, at a particular price, I want it to stop me into that at 50 or above. I typically only use stops for when I'm selling something. Very seldom have I use a stop to buy into something. And then here you got trailing stops. So trailing stops, think of it like this. Say for instance, if you say, hey, the stock is at 44.56, and a trailing stop is to say, how much room do I want to give this stock before I sell it? Let's say you'll give it $3 cushion, right? So if you give it a $3 cushion, then you can put in a trailing stop for $3. And this trailing stop, and you can actually put in it as a dollar amount, or you can put it in as a percentage amount. So it says T stop with a dollar amount, that would be the dollar amount. So if I put in 300 here, that'll be a $3 trailing stop. So what happens is, if it's trading at 44.56, then it's gonna go off at the order will be at 41.56. But as the price moves up, then the trailing stop is gonna always trail $3 behind the highest price. So in this case, let's say the stock went to $47. Actually, let's say it went to $50. Then the stop is going to rise up to 47 because it trails by $3 behind it. So think of it just as it lags behind, and you can specify how much you want it to lag behind. And what that does is it helps you as the stock continues to move up. But let's say we got this trailing stop in right now at 44.56, $3 trailing stop. If the stock went back down to less than 41.56, then the stock will get sold at that point. But if the stock continues to rise, that trailing stop is just going to continue to lag $3 behind the current price. And so that's a trailing stop with a dollar amount. Then you have a trailing stop with a percentage amount where you can put a percent in. So you can say, hey, a 1 whole percent, or 10%, or whatever. So that's just another order type. So those are like the main order types that you have. Again, you have market order. That's going to get it as quick as possible. You got a limit order saying that I want to buy or I want to sell at a particular price. You have a stop. Typically, I only use stops for when I own a stock already and I want to protect profits. And I say if it goes below a certain level, or say if you bought the stock at $44.56, and you say, you know what, if this stock goes below $40, I want to sell it. So you can immediately put in a stop order at $44.56 on a stop limit, at $40. And so you will give yourself that ability to do it. Now, what the difference is, you'll just give yourself that cushion to the downside. So that way you can always protect how much you would lose in a particular stock. So you can chart all of that out and come up with your entry points, what your stop losses will be. That way you don't have some event that happens that just takes you out. Now, the only caveat to that statement is overnight things can happen when the market is not open. There could be, geopolitical news, news about the stock, earnings or whatever, and the stock will start trading below what your stop may be or what your limit may be. And in cases like that, there's really nothing you can do about it. If it's lower than what your stop is, you're going to automatically turn it into a market order, and it's going to get filled probably in the first few minutes of the trading session. So that's one thing to be mindful of when you have stops on. So sometimes you can get stopped out of something only to see it shoot down in the first, few minutes, first couple hours or whatever of a trade. And sometimes it reverses and goes up. So, just be mindful that can happen. So those are order types.